Mm. All right, let's get started. Welcome back, everybody. Hope you all had a good week. This time we're gonna start diving into some of the more interesting, complicated topics. We're gonna start talking about the different things that we can use to actually evaluate each individual position that we're putting in our portfolio. Last time we talked way more, like I gave you some samples, but we didn't really drill down to why each of those fit. We kind of understand the basic things of what kind of assets and what kind of funds and why some of the ones that we picked were better. But we're going to look at a lot of specifics so that when you dive into actually picking individual funds, you have a much better idea of how to evaluate them. And most of this is going to be based on a Morningstar report. That's just kind of what we use as the basis. But you can find a lot of other evaluation softwares out there that will give you some of the more similar information. All of this is universal. None of what I'm going to talk about today is particular to Morningstar. I just like the way that Morningstar lays stuff out. And we can go back and look at some Morningstar reports after we get finished here. And again, like I mentioned last time, we do have a couple ways. We have a out of a different states library card that you can get access to, which is a much less expensive way to get access to Morningstar. So if you don't want to pay the subscription fees that Morningstar charges, that is something that has gone out in some emails and we can send out again. But let's go back over some of the stuff that we talked about last time, just so we can understand where we're at in this process and how this information is going to help us. So last time we went over using lateral and vertical integration to give us the idea of how to actually construct the portfolio. We got some vague numbers of how we might be able to put that together. If you just have absolutely no idea where to start, you can use these percentages, throw down the funds, and then tweak them to your liking afterwards. We built a sample portfolio with the funds above. Now, remember, this is just a total sample portfolio, balanced portfolio. If this fits your needs, great. You can use it if you like. All of these securities are ones that I'm currently using in our practice today. But again, make sure that whatever you're going to use fits your needs, fits your risk tolerance, all of that good stuff. But we created a portfolio with a little bit under 10% standard deviation over the last 3 years, with an average expense ratio of about 20 basis points. I'd argue we could push that down closer to 15, but this is just what I came up with for the class. So a couple things that you want to remember, especially moving forward as we start talking about these specifics and about any examples that we'll show. Each portfolio will take on a different form based on its purpose. You might have a portfolio that's totally made for cash reserves. Maybe all you want to do is generate yield and just get paid for your time there without taking a whole bunch of risk. I have an account like that. That's where I like to put my extra cash, emergency funds, all sorts of things. I want to generate lots of yield with that. And I'm a little bit riskier because I'm young and I can put my income towards that. But if you're using cash reserves to make sure that you don't fall short on living expenses, you'd want to be very conservative with that. Lots of short-term government bonds and such. A portfolio can be as simple or complex as you like, but regardless of how many funds you have, make sure it's diversified. So if we're looking at a Roth IRA that's not going to be touched for the next 40 years, you could just buy an S&P fund and leave it and be totally fine. That's going to fit the objective. It's going to do what it needs to do. It's going to give you lots of growth. But what we don't want to do is just buy an individual company stock and expect it to hit a certain level of growth down the line, because we have a lot of individual risk in that company. So if we're looking to get a lot of growth, individual stocks are fine, but just make sure you've got plenty of them so we don't have that failure rate of those individual stocks. We don't want one individual company that we choose, especially if you're choosing mid-cap, small cap, or even micro cap stocks. That risk goes much higher. A blue chip stock is probably not going to disappear, but you're still exposed to that risk. However, a small cap or a micro cap has a much bigger chance of failing. So we don't want to put all of our risk on that. I would prefer to have all my risk biased towards market risk and just lots of volatility. So bias your holdings towards low-cost investments, because fees can be a major detriment to performance, even with good performing funds. This is actually something I was just looking through Morningstar, and I was just for fun. I went to the ETF screener and I sorted by highest expense ratio. I just want somebody to take a guess what you think the highest possible costing fund was out there. Total guess. Anybody? 2.0 basis points. There have been a few that I've seen at 2%, maybe 2.5. This one was 13% of a management fee. Now, the reason for this is because it was a private credit fund. So basically, it was looking at private loans, private business loans that we wouldn't have any access to. We couldn't invest in those directly. So it's bringing a very special product to the market. Now, here's the crazy thing. You'd think, wow, that must be just killing all of its performance. Its yield, including expenses, after expenses, was still 8%, which means that it was generating like 21% yield. And then you take out that 13 and it gives you the 8. Yeah.
Explain basis point.
A basis point is just a percentage of a percent. So 1 basis point is a 100th of a percent. So if you've got 50 basis points, that's half a percent.
2% would be 200 basis.
Correct. Yes. So getting into today, we're going to talk about my favorite stuff, the fun stuff that I know the most about, which is modern portfolio theory, different ways to measure risk and return, and how to actually use those data points to create a portfolio that is most efficient. So starting, we're going to evaluate these investments with Morningstar, like I mentioned. They just provide comprehensive, in-depth look at the products to help us choose them. And there's a lot of metrics that we can pull from these reports. So everything that I talk about will be included on a Morningstar report. But like I mentioned, you can use them individually. They're not exclusive to a Morningstar report. They just happen to be my favorite things to look at when I'm looking at an investment report. So modern portfolio theory is the basis for how we're talking about a lot of these numbers that we're going to talk about. Modern portfolio theory is a practical method for selecting investments to maximize their overall returns within an acceptable level of risk. So I remember, if you remember a little bit ago, I was talking about how when you pay an advisor or you pay a fund manager a fee to select investments for you, you're not looking for the highest nominal return. Some might have that as an objective, but in my opinion, and in the opinion of a lot of people in the industry, what you're really looking for is you're looking for the best risk-adjusted return. So for the level of risk that you're taking on, if that's half the market risk, a quarter, 75% of it, we want to make sure that we're squeezing out as much return within that risk profile so that if I'm taking on a certain level of risk, I am getting what I'm paying for. Like if I'm going to pay for that return with the risk, because that's the trade-off, you pay with more risk and you hope for more return. I don't want to have a really high volatility and a really tiny, crappy return that I could have just gotten in treasury bills anyway. There would have been no point in doing that. So modern portfolio theory is a way to sort of quantify that idea and really put it down into numbers and evaluate these investments. And remember, it's all based on periods of time. So if we look at these numbers on like half a year, that's not going to tell us very much. But if we're looking at 3 years, that might give us a better idea within the constraints of the current economy. 5 years might give us some better data. And if it's existed for 10 years or more, that's where we really start to see the value in all of that data put together across multiple economic cycles that's really giving us a good idea of what it's going to do long term. So this mathematical framework is used to build a portfolio of investments that maximize the amount of expected return for the collected given level of risk. Of course, our expected return is not a guarantee of what we're going to earn. We know that. We've talked about that many times. But when you're looking at all the historical data, it's really just optimizing that and getting a good idea of how much risk am I taking on, and should I be expecting to get a decent level of return for the level of risk that I'm taking. So the person who pioneered this whole idea was Harry Markowitz. He won a Nobel Prize, actually, for doing this. And he basically developed modern portfolio theory. And all of this is super popular still today. I almost guarantee that if you have an advisor, they're using modern portfolio theory to build your portfolio. And there have been a lot of people that have improved on his subjects. But initially, he was the one who coined it and created these ideas for us to work with. So this is kind of a visual representation of how you can think about modern portfolio theory. You don't have to understand this concept entirely, but we're going to look at 2 different axes here. On the horizontal, you've got your level of expected risk. So you can think of this as standard deviation or beta or something along those lines. How much volatility am I looking to see? And the further we go on expected risk, we would like to see more expected return. And you can see that represented by something called the capital market line, which is a little bit of a calculation to say, if you're moving this way, you should get more return somewhat equal to this. And pretty much everything everything on this curve here is sort of what was called the efficient frontier and is what is considered efficient for that level of risk. And the ideal market portfolio is some combination of all assets within here. You've got your treasury bills over here, your risk-free rate. You might have small cap growth stocks all the way out here. Some mix of that is going to give you the best market portfolio theoretically to give you the best level of return for the given level of risk. And we would think that that's the ideal one. So that's just, this isn't something we're going to use practically. We're not going to draw out this graph and plot all our investments on there and move them around until we finally hit the right portfolio. But it's just kind of like all the game is moving around all these pieces to try and land on a portfolio that is the best for the given level of risk. So modern portfolio theory is not perfect by any stretch of the imagination. It's not going to make predictions for you because it makes two key assumptions. There's two things that it just assumes across the board are going to happen 100% of the time. One, that's that the stock market reacts instantly to new information. The moment it drops, it's priced in. There's no way that you can catch that. There's no lag, nothing. And it's that all investors are risk averse, so they're not looking to take extra risks, and they're completely rational. I'm sure you know a few non-rational investors. Maybe you've been one yourself. So maybe on an average basis, if you look at everything in the market, because there's so many different types of market participants, retail investors are really not that big in the big pool of investing. There's so much of pension plans, insurance companies, 401ks, all types of stuff that take up huge pieces of the market share. But these are the assumptions that this is based on. And when you start to get to average numbers, index funds, all these sorts of things, the data kind of lends itself to those assumptions. But if you start moving down to individual stocks, individual securities, alternatives, that's when things can start to get a little funky. And also, historical risk statistics break down on smaller time frames. So like we've mentioned before, if you were to look at a S&P 500 fund and go, it returns approximately 7% a year. Why did it decline by 48% this year? Because when you go down to a small time frame, those averages don't play out. In fact, most of the time, most years are not the average expected return. Most years are something wildly different. It's over time that those numbers start to, on an annual basis, if you average them out, start to come closer to that average. So our goal with modern portfolio theory is to select and optimize our security selection within the allocations that we've already determined with lateral and vertical integration. So we would have hoped that we've already determined this is where my least risky things are, something like a treasury bill, something like a money market, whatever. And over here, I want to put small caps or tech or whatever it is. And you kind of have a general idea of vaguely what sort of numbers, vaguely what sort of volatility you're looking for. And now we go into the marketplace, we go into maybe the Morningstar screener tool and look at all the available ETFs and mutual funds and think, what fits in there that I believe in investing? So there's a couple different things that we can look at on a Morningstar report. And we're going to start with one of the most easy to understand ones, which is beta. You probably have some idea of what this is, but it's a measure of volatility or systematic risk. So like we mentioned before, that's your market risk. That's the type of risk you can't diversify away. You can manage with different types of exposure, but you can't get rid of this risk of a security or portfolio compared to the market as a whole. And generally, the market as a whole is represented by the S&P 500. So that would be our benchmark. A security with a beta over 1.0 has more risk than the market. It's going to move up and down more. And so if you say it's 1.5, if we see a 10% rise in the S&P, it's likely that we will see a rise close to 1.5 in this asset that we're comparing. A security with a beta under 1.0 has less risk than the market, which again is just referring to volatility. It's not referring to any other type of risk. It's just that market risk, that movement up and down, the systematic risk that we're looking at. Above 1.0 is more, below 1.0 is less, and about 1.0 should have roughly similar volatility. That doesn't mean that it will return in the same directions on the same days. That doesn't mean that there's other risks that are not present. It just means that for market risk, for systematic risk, assuming that we've already diversified this holding, it should have whatever the beta says, should have roughly that amount comparably of risk compared to the S&P 500. Any questions on that metric at all? Okay. So you don't need to worry about how to calculate beta, but it's just, I figure I'd throw it up there for anybody who's mathematically inclined, who likes to look at this stuff. You're basically just looking at the different types of variance in the portfolio when you're looking at all of these returns, and you're taking into account the return on the stock or on the fund or whatever it is that we're looking at, the return on the overall market as represented by that S&P benchmark, how the changes in the returns are related to the change in the market's returns or the benchmark's returns, and how far the market's data points spread from their average. All of these things get put together, and you finally get this beta coefficient that tells you roughly how volatile this asset is in comparison to your benchmark. If you care and you want to read up at all, Investopedia has a lot of really good information. If there's ever individual things that you're confused on, individual words or terms or different calculations, Investopedia is a fantastic resource. It's not going to give you your hedge fund manager's version of it with all of the little nitty-gritty details, but it will give you plenty of information to look at to hopefully just give you an idea of how it works. And for the most part, we don't care about being able to calculate all these different things, but we just care about where does this information come from? Where does this statistic originate from? So I can understand why it's effective at doing what it does. So in practice, we're going to look at a couple different slides here. We're going to look at 3 slides that are going to show a comparison between the S&P 500 index, represented by that ticker SPX, which is the index itself, and a chosen ETF from Vanguard to display how beta can be seen in real data. So we're going to look at historical returns, look at a line chart, and the S&P 500 will be represented by a purple line chart, while the comparing ETF, whatever it is we're looking at, is going to be represented by a yellow or gold line chart. So we're going to look at these charts and determine whether we think the investment has the same higher or lower beta. So I'll give you a little bit to look at the asset and tell me what you think, if it's going to be higher, the same, or lower. So firstly, we've got this asset right here. Wild guess, what do we think the beta is on something like this? We agree? 1.0 sound about right? It was actually 1.01, so I'm sorry, I'm going to have to deduct a point from your grade. So this was Vanguard's total stock market ETF. And this really puts into practice what we were talking about before, where when you compare an S&P fund and a total market, you're going to get the same return. It's those top stocks driving it. So if you want to pick the total stock market, that's up to you. In my opinion, just pick the one that's cheaper. Like if you're with Fidelity and they give you a total market or an S&P 500 fund, the total market costs you 5 and the S&P is free, take the S&P. It won't really matter at the end of the day. I would just pick the cheaper one. So next we've got this here. Remember, our comparing asset is the one in gold and our S&P is the darker line. So do we have any idea where we think this is going to land a little bit? A little higher? I think it's going to be a little higher than 1? Congratulations, the beta was 1.20. So if the things that are going to really tip you off that is obviously you can see it reaches a lot higher in bullish markets. And you can also see if you kind of look at this area between 2022 and 2023, if you just look at kind of the distance that that other asset fell, it fell much further than the S&P 500. In fact, that volatility looks like in that instance almost twice. It was a big drop from there and even recovered more strongly than the S&P 500 did. In some of these areas, it looks a little bit closer because that's what stocks did at that time. But you can really see that when we get to this area, it really starts to stretch out. So that average data really starts to play in. So that's Vanguard's Growth Index ETF, ticker VUG. It has a beta of 1.2. It invests in growth stocks, a lot of large cap growth stocks, probably a lot of tech stocks in there. I forget what the actual holdings are, but we can take a look later. But that basically shows you that's what a higher beta looks like. Yes?
On the total market index had the 1.01 beta, right? That 0.0 or that 0.1 could have been caused by some small cap stocks.
Sure.
Like that.
It could have been anything that was in there that did not have to do with the S&P 500 index, or it could have even been, you know, just what their allocations were at the time, whether they made a shift, all those different sorts of things.
That's a pro or.
Yeah.
Could be slightly more volatile than the S&P because it has kind of like the tail of a comet.
Mhm.
It has some little small caps.
Yeah.
But on the other side, someday, we haven't seen it, but it might give you a little boost.
Possibly. The only issue though with that idea is that the weightings basically end up making it an S&P 500 fund anyway. All those little holdings are so small, I would be shocked if they even totaled 5%.
Why even do a total market index?
Exactly.
Sounds.
Yeah, it sounds great. And maybe if you do an equally weighted, maybe you'll get some different information, and maybe we can look at a fund like that and sort of use some of these metrics to look at that and evaluate it, but we'll talk about that later. So now here we've got one more asset. So I'm sure you can see the trend of where we're going. I'm sure you can guess what's going to happen here, but for the sake of exercise, where do we think this is going to land in comparison? We're like 0.8, a little bit lower. Look at you. You got your point back. You're right back to even. Congratulations. So, yeah, exactly. I got a position for you. So we've got a Vanguard Value Index ETF, which, as we talked about before, that's your companies that aren't looking for a lot of growth potential, lots of dividend paying stocks, stocks that just, really the word value is, we're not overpaying a crazy amount for this company in completely arbitrary measured things, and price to book, price to earnings, all those other fun fundamentals that we haven't really looked at. So beta can give us a general idea of just how risky any security or collection of securities can be. And it can be used for evaluating both individual funds and even stocks, but I don't really like using beta for individual stocks. And I'll tell you why, is because beta becomes very not useful when it's non-diversified. A diversified fund or a diversified portfolio, beta is very useful because we're comparing two diversified assets. But when you get down to individual things, and there's tons of research that explains this that I can't recall right now, but beta is not super useful for an asset that's not diversified. So if you've only got a couple stocks or one stock, beta is not going to be very useful for you because it just is not going to be measuring the same type of data. Yes.
How often does the beta value crash?
So that's a good question. That's like a constant calculation based on the historical data. But one of the things you might look for is what time frame it's looking over. So you'll have, on a Morningstar report, you can have 3, 5, and 10 years. Generally, I tend to look at the 10 years if the fund's been around for that long, because I just want to see how is it done in multiple different cycles? How is it done in bullish cycles, bearish cycles, all of those things pulled together? How is it going to do? Because if you look at only 3 years, I mean, just recently, like if we go back to one of these charts, if you just picked like this period right here, and then you measured that statistic, you just have this one straight line up versus whatever else you're looking at. And that might give you a very skewed piece of data. So I like to look at the much longer time frames. But I believe that's recalculated every day based on the daily returns.
Good point, because a lot of these reports not just for that, but I think crash, and all of a sudden everything forward, we have to find out what this fund is about.
Yeah, that's one thing that actually that he does a lot is he'll go back and look at certain years like 2022 and evaluate particular funds and see, okay, I understand what the volatility is overall, but how did it do at this particular time? Did it handle this market correction well? And sometimes I'll pick a fund and I'm like, this looks great, all these things look good, and he pulls it out. Well, look what it did in 2022. It did just as bad as everybody else, but your statistics say otherwise. And so then we'll have a little back and forth and we'll find a replacement for that. So, you know, these statistics are useful, but if you go to small time frames, a lot of that will come down to luck, frankly, or where you happen to be in the right asset that didn't feel that correction at the time, or possibly some active management from your manager, which oftentimes also ends up being luck too. So, you know, so remember that beta is relative, and it's important to understand what it's comparing to. So in most cases, it will be the S&P 500 index. However, one thing I found was when I was running individual Morningstar reports to pull numbers like this beta, is I noticed that when you pull a fund report on an individual fund, it will actually pick the most related index to compare it to. So now your beta is not versus the S&P 500, but it's rather versus whatever index that they picked. And they'll give you two. They'll give you one that's sort of the standard index to compare that asset type to, and one that they think is the best category fit. So there will be two of those there, and I believe the first one is what all the beta numbers and everything are calculated for. But you might be looking at an asset and go, this preferred stock fund has a beta of 0.95. That doesn't really make any sense. Then you look up at the index and you go, it's comparing against hybrids and preferreds and all that stuff. So just something to keep in mind is make sure you understand what index is being compared to, and that should be notified somewhere in there.
You take Morningstar and stuff?
Yes. Yeah. So that's if you pull the individual fund report. So what I did to counteract that was I just went and made a portfolio and just put one holding in there and then forced it to compare to the S&P 500. So that's how I pulled these numbers
So
out.
they'll do that they'll pick the index for the individual fund.
Yes.
You look at it, but when you create a portfolio, you can pick the index and compare.
Well, in Advisor Workstation, you can.
Okay.
In Morningstar Investor, I couldn't actually find the reports that we use. So I'm not 100% sure where all that would be. But if you want to see any of the reports that we use in-house, we're happy to run your portfolio through Morningstar just to give you an idea.
I've always been confused that I can't, I know my fund, but I can't pick the portfolio.
Yeah, that was really strange to me, and I was trying to figure that out, especially when I was pulling information for these slides.
Because it's an individual fund, so they're going to compare it. It's all.
Yeah, so it totally makes sense. But it's just something to be aware of. Generally, people are going to use the S&P 500, but look just in case to make sure you're comparing against what you think you're comparing to. The next thing we're going to talk about, which is directly related to beta, is alpha. Alpha is basically how much more did I make for the level of risk I took on. If you just think about what we've been talking about, where there is the nominal return, which is just what percent did my asset go up, that might be more or less than we expect based on the beta that's measured for the individual security. So if we're looking at an asset and its beta is 1.0, the S&P goes up by 10% and it goes up by 12%, we go, oh, would you look at that? The beta said it was going to go up by 10 and it was going to go up the same amount as the index, but we actually got a little bit of extra. Could have been an individual stock that did that, a sector, doesn't really matter. But we have a little bit of extra return that we did not expect. So that extra return, with some calculations, gives us our level of alpha, which is the extra return, or really a fund manager's value. That's why if you ever hear about people talking about hedge funds or funds and they go, how much alpha did you generate? It's because that's how much extra return they were able to create based on the level of risk that they were taking on. So this is something that I usually like to see. I'm not creating a portfolio for alpha, but if I create a portfolio and I notice that I have a bunch of negative alpha, I'm going to go, okay, what did I do wrong? Why did this do so horribly compared to its index over this period of time? So it uses beta as a gauge of risk. It uses beta to tell us how risky this should be, how much volatility we should see, and how much return we should get from the security. So the returns above and beyond that expected amount for the risk we're taking is what are expressed as alpha. And it's, like I mentioned, is generally viewed as the value a portfolio manager adds or subtracts, because they can subtract it, from a fund's return. Yes?
That net returns or gross returns, like are the fees that the portfolio manager charges accounted for?
Oh, that's a good question. I believe they are. I believe Morningstar tends to bake all that information into its data. I know that when they calculate SEC yield and stuff like that, those are baked in. I'm not 100% certain on that, but I would assume yes. But
The fees are on the funds, and then you have to plug in if you have advisors.
right, so that would be, yeah, that would be something to
It's like
plug.
a price release, right?
Yeah, a little bit. Yeah, yeah, a little bit like that.
Make sure you're not paying for your advisory.
Mhm.
So how to see that, clearly? Is that just the one alpha number or?
Um,
Front fee versus the.
Yeah, I don't know, it won't come up in, it might, because now they make us, if you have an advisor fee and you're gonna do a portfolio, you have to plug that in on each little thing. And so it's net, let's say net, less 1% a year or something like that. And I don't know that it does affect the alpha.
Yeah, that's actually curious. Shaniqua, could you remind me next week in the office to compare portfolios like that with and without fees? Thank you. So we'll take a look at that. Anyway,
I'll bet it won't because it has to.
Yeah. Yeah.
Upside down.
yeah, so that's another one of those reasons where I'm kind of the opinion where the reason you want an advisor is either for peace of mind, and that's what that fee is going to, or you're paying for the other consulting services around that, and that's just how they happen to get compensated. Paying an advisor to get you better returns, it just really isn't, it's not really what you're going to get. Some people are going to tell you that they can do that, but you don't really see it. It's just period ever. Short-term basis, sure, maybe. You'll see people who get these nice big returns. But you go long-term and you bake that cost in, it almost never happens that you can actually pay for all that extra alpha. So, it's nice.
Show that it did better by 3% a year with an advisor, but not because of his or her performance. It was because they kept you from making mistakes. Now the market, and you get the overall thing. The biggest value in a fee is that somebody doesn't have the time or desire. It's like having your own garden. If you love it, then we want you to read the book 3 times to quit your deal. You're an advisor. But if you don't, then you go and hire people to do this. Because most of the work is done at the end of the financial plan and the portfolio construction. It's the administrative follow-up and all the work that has to be done beyond that.
Yeah, so if you're kind of looking at it from that perspective, I guess the way you can kind of think of your advisor is not so much that they're going to be the best investor ever, but what they're really going to be is your investment therapist. And they're going to stop you from making huge mistakes. They're going to stop you from killing your returns by getting out during bear markets. They're going to encourage you to invest at risk levels that make sense because they've done the math, they've looked at your situation, they have a really good idea of how to stretch those returns and what kind of safety you need and what has been provided for you. So I think that's kind of the biggest benefit, is getting that peace of mind and being like, I know that they've looked at my situation and put things where they need to be, rather than that they're going to generate something extra. Because realistically, if you want the best returns, buy the Vanguard Growth Fund, close your eyes, look away, plug your ears, and come back later, and you'll be fine.
Usually 10 years or so.
Yeah.
If you meet somebody over the counter or somebody's just going to help you get all invested, we've run into people that have gone to other companies and sold everything and rebalanced everything. The only problem is they have a lot of gains built up, and you got to make a profit. So now you need a budget. That. Now we have an advisor that's up on things. You have old mutual funds, huge gains that are allowed in funds. What do you do now? Well, you watch what Nash does daily. He watches interest rates. Weekly, he has to listen to podcasts to talk about the new ETF funds coming out. Well, what about my old mutual fund? Well, that company is trying to get SPAs back to do a new ETF for the new share class that will receive your old mutual fund and not trigger tax limit. Right? So if you've got an old fund that's lousy in the advisor, if you have somebody that's in this, because we have things we do daily, monthly, quarterly, biannually, yearly. But if you've got an old high cost fund and you sell it and let S Nash go around, you could die and your family can sell it if you can. Now you have a huge tax liability. But if that's an American fund or another older fund that they're converting into an ETF, a certain share class, the advisor should be aware of it. Or if you're the advisor, ETF fund, ETF fund, right?
Yes. Yeah.
That one will let you know what's going on with ETFs, usually new ones, but the new ETF share classes coming out, or they want to come out, are the conversions from mutual fund to ETF and not triggering capital gains, and they're a lot more tax efficient.
Yeah. Okay, so now let's take a look at alpha's calculation. We took a look at beta. Beta is a little more complicated. That one's a little over my head, but alpha is much more simple because it's using that already calculated beta to give us an idea. So pretty much how alpha works is it's got a couple different elements. You've got the return that you made over whatever period of time it is that we're measuring. You have a risk-free rate, which generally is referred to, it's the theoretical rate of return of an investment with zero risk, which is usually represented by the interest rate of a 3-month treasury bill. So if you remember, we had that fund SGOV that was like a 5% yield right now. Now, obviously, interest rate on a 3-month on an annual basis is going to be kind of high, but you never know. Interest rates could change in the meantime. But this is mostly theoretical anyway. So we're looking at that risk-free rate that we can get by taking on absolutely zero risk. And then we're plugging in We're going to take the return of the market, so the S&P 500, whatever we're comparing to, we're going to subtract the risk-free rate from that, and that gives us what's called the market premium. So that's basically the extra return that the market is giving you for having taken on risk. So that's over the risk-free rate that you could earn by taking no risk, and then we get the extra return that you would get by taking risk. Now we have that piece. We take that extra return and we multiply it by the beta for our individual security, which then gives us the expected amount of return that we get for taking risk. And then we add back the risk-free rate. And now we have what we should have gotten. So basically, that whole period in the brackets here, all of that, that's the return that we should see from the asset. So if we have a growth fund that has, 1.5 times, I can do a little bit of the math, but it gives us our idea of how much return we should get for the level of beta or the level of systematic risk that we're taking on. Then you subtract that from the return you actually got, and that gives you alpha. That gives you either the extra return or the return that you missed out on by just being in the market at a similar level of risk. So it's a simple little calculation, and it just gives you basically how much extra did I get or how much did I lose compared to what I think I should have gotten based on the beta of that. So alpha accounts for the risk taken, as well as the return that could be made by taking zero risk, giving a truer measure of excess returns than simply comparing nominal returns of assets versus their benchmark. So if you were to take the S&P 500 and your growth fund, and you see the difference, and you just subtract it, and you go, look at all this extra money I made, we are not taking into account the extra risk you took on to make that extra money. This does.
If you compare the S&P 500 to an S&P 500 ETF that has 5 basis points of cost, then the fund that has the cost has to have a slightly negative.
Yeah, they'll have tiny little bit of negative alpha just based on that fee. And sometimes there will be a small cash position as well sitting in the fund to pay for expenses and all sorts of things. So that little tiny cash position plus that management fee will take away the tiniest amount of alpha. It's not very much. It's not worth worrying about. But if you really, really hate the idea of missing out on that, just go buy all the individual stocks in the S&P 500 and enjoy that incredibly long list of positions on your statement every month.
To that cash for usually or mutual fund. Or do
Not necessarily. No, they'll have very, very, very small cash reserves because they have to pay for fees. They have to pay for the operating expenses of the fund. So those operating expenses come out of their cash position, which comes from the buying and selling of shares. Sometimes if they're actually selling shares, which they can do, they don't generally do, but they can buy and sell their own shares. Yeah, and they can keep those in order to generate cash to pay for expenses. Yes. And so in practice, the riskier an asset is, the greater returns it will need to generate to produce alpha. Index funds don't have alpha. And if anything, they have the teeniest little bit of negative alpha for the reasons we just described. And this is because they track and perform the same as the given index. We're not expecting alpha. We're not expecting anything from that. Unless for some reason the index changes and the index fund doesn't change in time, and then that one some black swan event happens, you're not going to see alpha in an index fund, so don't expect it. So if you're invested in all index funds, you go, why don't I have any alpha? It's because you picked index funds. That's just what you should expect. So short time frames can skew alpha a lot, very greatly during unusual economic cycles or due to the performance of one stock inside a fund. Anybody remember ARK Invest, Cathie Woods? Well, let me show you. Here is the ARK Innovation ETF, which is a company, ARK Invest, led by Cathie Woods. That was their main person, still is. And we have down here the Tesla individual stock. Now, if you'll notice some slight similarities in the mountain charts here, you'll notice that as Tesla stock starts to ride upwards, coincidentally, ARK just happens to also fly towards the sky as well. And this is because I don't remember what the actual concentration number was. I couldn't find that quickly enough. But they had a huge position of Tesla in their fund. Absolutely massive, because she was completely convinced that Tesla was going to do amazing. And so when Tesla went flying upwards, her fund as well, the net asset value of everything in her fund started really going up towards the sky. But if you look at every single other period, her fund does not do that well. From beforehand, it didn't really move that much. And afterwards, it stayed basically flat ever since then, ever since they rotated out of that giant position, because they realized when it came tumbling right back down due to this volatility here, they were like, okay, maybe that wasn't the smartest idea to have 15 or 20%, whatever the ridiculous concentration was in that individual stock. So if you were to look at this period right here and compare that to the S&P, you go, oh my God, she's a genius. This is the best growth fund I've ever seen. I'm putting all of my money in here and she's going to make me rich. And then it falls.
And you paid her probably 85 basis points.
Exactly. And then you look at all this historical data, you look at all of this, and then you realize if I had just invested in the S&P, I would have ended up at that peak anyway if I just stuck it out. So that's something you really want to remember is when you're looking at alpha, long term, please look at 5 years at least, if not 10 years. I want to look at these big, I want to see the managers do something well for a long-term basis. And it's okay to have short-term alpha, but understand why. Look back at what happened, at what their holdings were, and understand what caused them to have that alpha. And really look at the other returns as well and think, okay, is it realistic to expect this? And if not, how much worse is it going to get if I subtract out that period? So just don't be fooled by short time frames with incredibly high alpha, because you'll see, you know, like if you just look at any growth fund, you look at 1 year, it might have the best alpha ever, but then you stretch out over 10 years and their managers have been making horrible picks otherwise, and they just got lucky once. So the next one that we're going to talk about is R squared. This one is not, it's not quite as simple to understand as the previous two metrics, but it doesn't really give us that much information to use for building a portfolio, but it can give us a little bit of nuanced information that we can take into account. What R squared essentially tells you is the percentage of a fund or securities price movements that can be explained by the movements in the index you're comparing to. So if you're seeing a bunch of returns in a particular security in a particular fund, and you can look to an index and say, these movements over here are explaining the volatility, the same things that are happening over here are causing these returns, then you would have a high R squared. An R squared of 100% means that all movements of a security are completely explained by movements in the index. What kind of fund do we think would have an R squared close to 100%, maybe 99? Exactly, an S&P 500 fund. If you're comparing that to another, if you're comparing that to an S&P 500 index, that's going to have an R squared incredibly high. So we can use this to gauge how similar our investment is to whatever comparable index we're looking at. Obviously, we can look at the holdings, we can look at the beta, all these different things, but we can see how much of the returns of the fund that we're looking at is explained by the comparable index. So this can be useful in determining if there's value in high fee funds that invest in a common sector of the market. Because if I'm looking at a high fee fund and I am comparing it to the S&P 500 and the returns are kind of similar, maybe a little bit more risk, maybe I'm making a little bit more, but my R squared is almost 100%. Like, what am I paying you to do? Buy more Apple stock? So it's kind of one of those things that you can use. It doesn't necessarily tell you this fund is good or this fund is bad. It just tells you how much of what we're seeing from this fund is explained by the index that we're comparing to. That's kind of a difficult concept to wrap your head around, but it can be useful in some instances. So really, you just take all the unexplained variation, the unexplained returns, and the total variation, you divide them and you subtract that from 1. And it's, again, if you want to learn more about this, check out Investopedia. We won't dive too deep into it because we don't use it that much. But I will show you what it looks like on some charts. So the next 3 slides will show a comparison between the S&P 500 and a chosen ETF from Vanguard to display how R squared can be seen in real data. The S&P 500, again, represented by that purple line chart, while the comparable ETF is represented by a yellow line chart. So together, we'll look at these charts, just like we did with beta, and determine whether the investment has a strong or weak R squared. Now, strong is considered above 70%, and weak is considered under that. And something to also keep in mind, R squared helps you determine how valuable beta can be. I think I have this on a slide in a second, but the higher the R squared is, the more useful beta will be, because the more similar those assets perform in terms of their variance. So we can more reliably use beta to judge the amount of risk that that investment has. So here we've got two securities, same first slide as before. What do we think about the R squared of this fund versus this index? Think it's going to be strong or weak? You agree? It's going to be strong? We got 99.32%, almost exactly the same, because as you can see, almost all of the returns in that fund are explained by the returns in this index. Again, proving the point that these total market funds that are market cap weighted are completely explained by movements in the S&P, if not maybe just by the Magnificent Seven. So you have that total stock market ETF, which again, super high R squared, even though it has thousands of funds. And an S&P 500 has maybe 503 or 505, something like that. But even so, that market capitalization weight of those top companies is completely explaining the returns of our total stock market ETF. So again, that beta and that alpha, the R squared, all of it is just really supporting that idea that total stock market ETFs, if they're weighted the same way that an S&P 500 fund is, it's going to basically be an S&P 500 fund. So we've got another pair of assets right here. So what do we think about the R squared of these two assets compared? Do we think it's going to be strong or do we think it's going to be weak? I think it's going to be weak. I mean, we can look at maybe an area over here where the stock market traded relatively flat and our asset fell. Some areas where it's kind of similar and some areas where it's not. So this one has an R squared of 37.47. Much weaker, much lower. If we use the beta of this to compare against the S&P 500, it's not really going to tell us a lot. So if you want to be able to really reliably use beta, what you might do is look for indexes of which this has a really high R squared in comparison to. So if I'm looking at this, which is a Vanguard Energy Index ETF, and I compare it towards whatever index this is following, I'm going to see a really high R squared, 95, 97, 99, whatever. And then I can look at that beta measurement and go, okay, now I can understand the risk level of this a little bit more comparably to that. So we've got another one here. What do we think is going to be the R squared of this? Strong or weak? Strong? Strong? Everybody think it's going to be strong? Pretty strong. Even though the volatility is much greater, you can still see that the directionality is almost exactly the same. It's just more exaggerated. It's stronger. So even though different holdings at different weightings, there's a lot of similarities in there that show that R squared is high. So because of that, we go back to our beta of 1.2. We know that's going to be really reliable, because we know that these assets perform in similar variations. So now we know that that beta is useful, and we know that the alpha is useful. So if we look over the time period of 5 years or 10 years, and we look at the alpha, if we see that it's positive, we go, I know that that's pretty reliable because we have these measurements over long periods of time, and the R squared is strong, showing us that it is a worthwhile comparison to make. R squared tells you how much of the variance of a security returns can be explained by the index you're comparing, like we talked about. R squared above 70 is considered strong, and we would expect an index fund to have a very high, if not just about 100% R squared. The higher the R squared, the more useful beta is as a measurement of risk. With a weak lower R squared, standard deviation becomes more useful, which is what we're about to move to in a second, right up to the slide. Oops. So remember that the index you compare to determines the validity of these relative risk measurements. And that R squared really kind of helps you determine whether you're using a valid index or not. If we compared VNQ, which is the Vanguard real estate ETF, to a real estate index, the R squared would be strong. If we compared VDE, the Vanguard Energy Index, to an energy index, the R squared would be strong. So these statistics need context. Not all of the investments fit into well-understood categories, which is why we need isolated measurements as well. All of this is super relative. All of this is based on other indexes, other indices, other investments, which is why they're useful relatively and why we like these measurements for diversified funds, for diversified investments. However, when we move to new things, when we move to other types of funds that don't have a good comparison, maybe you have some sort of super strong, like one of those private credit funds that charges like 9% expense ratio, kind of difficult to compare that to something, and beta is not going to be very useful. So we might look at some of these metrics here, which are isolated, and you don't look at an index, you're only looking at the data for the individual fund, security, or whatever it is that you're looking at. So we've got three key ones that we're going to look at on Morningstar reports. The first one is the mean return. This is the expected value or mean or average of all of the likely returns of the investment comprising a portfolio. So generally what we're looking at is we're looking at all of our funds put together on a Morningstar report. If we go back in time, we look at all the data, we average everything out. What do we expect on an annualized basis? Remember, not every single year, but if we stretch that out over 5 years, 10 years, 20 years, what do we expect the annual return to be on average? We've got standard deviation, which is the dispersion of a data set relative to its mean. I'll explain that in a second. Sharpe ratio basically is like if you wanted to do alpha, but you didn't want to be comparing to an index. Sharpe ratio is the next best thing and sometimes can be a better measurement of excess return. So it divides a portfolio's excess return, all of the extra that you're getting, by a measurement of its volatility to assess risk-adjusted performance. Basically, we're just looking at, based on the volatility and the expected return that we're looking to get based on the mean, based on that volatility, are we getting some extra for that? Are we getting some extra return? Are we getting good risk-adjusted performance?
Like an alpha.
Yeah, it's basically like alpha without an index to compare to. It's like if you're just looking at an individual fund completely in isolation, you're just looking at its data on its own, it's like generating alpha. So when we're looking at mean return, it's again the expected value or mean of all the likely returns, and it's established by simply taking the mean of all historical return data, whether that be by day, month, or year. So you could be looking at month to month and averaging those together. You could take every single day, average those together. You could take the annual returns, average those together. Doesn't really matter too much. So outliers can significantly skew the mean return, especially if the data set is small. So when we get, again, it's time and time again that I'm just really harping on this piece. If you look at small bits of data, if you look at short time periods, these measurements are not going to mean anything at all. If you're looking at a single year, it means basically nothing. So it's really important to understand how these outliers can skew the data. So the expected average return, as based on historical data, it's not a guarantee of future returns, but it is a basis for which we're measuring standard deviation around. Mean return is kind of where we think we're going to sit on average, and then we're going to look at the standard deviation, which is how far around that can we travel? How far up and down are we going to move? Where are we going to be on a general basis? So standard deviation measures the dispersion of a data set. So that's how far we're dispersing out into each direction relative to its mean or its average. So if you're looking at all the data, you're averaging out all together and you're saying, right here's where the average is. It's measuring how far we fly out in either direction. So this measurement gives us an idea of the overall volatility of any given investment. We're not comparing it to anything. We're just looking at its data in isolation. So returns may fall within or outside of the standard range. When we talk about standard deviation of an asset, of its standard deviation, we're talking about one standard deviation. You can actually have multiple standard deviations because they go pretty much out into infinity. Some of the data might not ever exist there, but not every single year of return is going to land right within one standard deviation. Let's take an S&P 500 fund, for example. Let's say it averages maybe 12% every single year, and the standard deviation, well, let's just make the numbers easy. Let's just say the fund returns 10% average a year, and the standard deviation is 15. So we would think that, okay, if we could go positive 15 more from that, we could go up to a 25% year. Or we could go 15 points below that average and go to a -5%. But you might see a -15 or a -20 or -50. You might see a +50 or even a +200 for some reason. And that's because standard deviation, one standard deviation, is telling us there's a certain probability of us falling within this range. But you can fall outside and it's still going to give you the same averages. It's still going to give you the same measurements. But you just understand that just because you see a standard deviation doesn't mean the investment is going to stay within the bounds of these guardrails forever and always. It's just simply looking at the average data.
So yes, if you're looking at your stock, things like technology stock. And you evaluate, what would be the denominator, like for technology, would be like XLK?
Sure. Yeah. So if I'm looking at that in terms of the basis of standard deviation, we're just going to know that it's going to be really high because those tech valuations can get really blown out of the water, just go really, really high. And when we're evaluating those, it's kind of, that would be again where honestly, at this point, you could be using beta and alpha to evaluate those because of how tech heavy our indices have become. Because of how much tech sits in S&P 500, you might not even have to worry about using these metrics for non-diversified funds because they almost match returns of diversified funds because of how much tech is already in them. So I might be looking at those beta and alpha metrics to evaluate a little bit.
You start hearing the word duration of tech stocks. I haven't heard about that in years. Duration, we usually talk about it as the length of the bond rate, it's the 1% duration. And Fed rates, interest rates are high recently. And now you could buy a CD at 4 or 5%. People drop the long duration tech stocks for CDs, and the word long duration came out. And it's a good reminder that if this is a long-term hold, 10 years or more, the tech stocks and the S&P is great. But in our world, we've got to dial people back and say, look, we're 5 years older. Are we willing to wait 10 years for a recover like stock that? Nothing wrong with tech stocks, but they are long duration.
So is the reason for stocks having duration is because of the debt that they take on to conduct business?
Not that I heard. The thing, and it may have been just some commentator just saying they're long duration, but it made sense because whatever's going to have the most volatility and needs more time to mature or grow, and we're starting to use that word for on a cash flow or a volatility basis.
Interesting. So standard deviation again shows us the overall volatility, good and bad, of a given fund or portfolio. More volatile investments have a higher standard deviation. More stable investments have a lower standard deviation. So we can use a target standard deviation to keep our portfolio in line with our risk tolerance, which will just end up being an average of the standard deviation of each position within it. So that's why we might bias towards more cash investments, more of that SGOV fund, or any of those treasury bills to bring the standard deviation down, though we might still have growth assets with much higher standard deviations, but they get averaged out to a level that is within our tolerances. And here is the most common graphical depiction of standard deviation. So when I reference one standard deviation, that means within this right here. And you can see these percentage numbers. These are probability measurements. So if you add those up together, you get 68.2%, which means that 68.2% of the data of everything is likely to land within this confine. But if you step out, you increase. If you're looking at this entire bit of data, all the way here, from down here to up here, you're going to collect more of that data because you have the chance of some more of these more outlier returns. And as you continue moving out with a third standard deviation, you're including an even higher number of returns. So even though most years on average will sit in here, you'll have plenty of these and plenty of these, and maybe even some way out here and way out here that all lend themselves to these average values, these average numbers that end up landing in those middle areas.
What's the y-axis?
So I'm not sure what it's measuring right here. I think this is just measuring like, yeah, I'm not sure what it's measuring in this particular graph. But yeah, what we're mostly thinking about is just kind of like how much of each section is going to fall in here. This is just like generic for other, yeah. So this one in particular is just kind of It's not pulled from an investment particular thing because this is used in probability and statistics, just kind of in general. So this is a very generic chart. I don't know exactly what they were measuring at this point, but yeah. So Sharpe ratio, like we were talking about, divides a portfolio's excess returns by a measurement of its volatility, in our case, standard deviation, to assess the risk-adjusted performance. Similar to alpha, but instead of using beta, it uses standard deviation as our measurement of risk because it's not relative. We're not comparing this to anything else. We're not gauging how this is doing versus the S&P 500. We're just looking at this on its own. So here's how Sharpe ratio is calculated. It's super simple. You take the return of the portfolio, subtract the risk-free rate, and then you divide it by the standard deviation of the portfolio's excess returns, the extra on top. And then that gives you an idea of the risk-adjusted return. So now let's just talk about a couple of extra things before we end up getting onto Morningstar and looking at a couple different investments and using all these different things. Let's look at a couple extra things that we'll also use that aren't modern portfolio theory. They're not those risk and return, but they can be useful. So here we've got a couple bond-related metrics. First, we have average effective maturity. So if you remember, maturity of a bond is how long it lasts. If you've got a 10-year bond, that means the bond lasts for 10 years, and at 10 years, at maturity, you'll get your principal back. So average effective maturity, and these are for mutual funds or ETFs, the weighted average of the maturities of the bonds in a portfolio, considering all the expected mortgage prepayments, puts, and adjustable coupons. So we're taking into account if you have, say, a callable bond, and it can be called early, or if you have a mortgage bond in there and people are prepaying their mortgage, they're paying extra on that and bringing the life of it down, and adjustable, all those different things. That's taking into account all those things that change the maturity of a bond and averaging it all together so you have an average idea of how long the bonds in the fund last. More importantly than that, though, we like to use average effective duration. Maturity is great and can be useful, but duration is what tells the story. Duration is what really tells us how those things are going to affect our portfolio. Duration is a measurement of a portfolio's interest rate sensitivity. The longer the fund's duration, the more sensitive the portfolio is to shifts in the interest rate. And the reason that this is basically what duration is doing is it's taking the average effective maturity, and then it's using the coupons that you're earning on that, the interest rate, the yield. It's using that, it's putting it together. And because you have a certain level of yield, if you had absolutely no yield and then interest rates were high, of course, the value of your bond would be almost nothing because somebody could just go buy a regular bond and earn interest. But if you have a bond that has a much higher interest rate than what's out there in the market, interest rates can move around, and as long as they stay underneath your bond, it's not going to be that much of a change. Even if it's a 30-year bond, but you're getting 15% versus 7 or 8 or 10, those little movements in those smaller numbers are just not going to affect the resale value of your bond that much because you're just earning so much more than the open market is. So I kind of like to think of it as kind of the payback period. Like, how long do I need to own this bond for the interest to have basically paid me for the time of holding it and paid me for the sensitivity that the bond has? It's kind of, yeah, I just really just think of it as how long does it take for me to get paid the value of having held this for taking on that risk to interest rates. So generally, roughly, every round number of duration is how much in percentage-wise that the bonds are going to move up and down in value when the interest rates change by 1%. So if you've got a duration of 5 years, and interest rates go up by 1%, it's likely that your bonds are going to drop by 5%, vaguely, roughly speaking, sort of generally. But the longer your duration ends up being, if your duration is 10 years, 20 years, 30 years, you're going to have much higher sensitivity. And those changes are going to cause a lot more fluctuation in the value of your bond. Because again, if you're holding a 30-year bond and it only pays 2%, but somebody can go get 5 in the open market right now on a 1 year, what's the point of holding your bond? Or even if they could get that in a long bond as well, there's just no point in buying your bond for the same principal value if they could pay that same $1,000 and get the 5%. Yes.
Value of the bond, what interest rates are redeemable or liquid, can you sell it before it's?
Yes, so you can sell a bond before its maturity. No, I don't think there's any penalties on selling a bond. Yeah, it's just basically, yeah, selling it right. Yeah. Yeah, so the penalty will end up being how much is somebody willing to pay? Because you think about it this way. You have your bonds in the normal market, say they're 5%, like right now, short-term treasury bills are like 5%. And if you're holding a 3% bond, the value needs to drop in a way so that whatever they pay for the bond, that interest rate equals 5%. So that 3% needs to be adjusted up to the market rate, and that will be a discount in what they pay for your bond. So if you paid $1,000, they might give you 700, whatever the number is, so that that 3% feels like 5. Because why else would they have bought it from you?
That's the price you pay to get out.
Exactly. Yeah.
But we've always had it ultra short. Maybe a little bit longer term. But we were in super short term talking about it. That. And 2020 comes along, the Fed raises interest rates, 22, right? Raises interest rates to try to slow inflation. And we're looking around, and this is where we gave up on fund management. Some of these good bond fund managers we hired, and the bonds dropped just as much as everybody else's bond. Because they didn't get rid of the intermediate term bonds and start putting things in cash in short term. We could see interest rates were going up, right? We all do that. Well, if you have bonds with a long maturity, you shoot the heck out, because if you try to sell it when rates are quite a bit higher, you're gonna lose. So even our short-term bond funds dropped 3 to 5% temporarily. And then when rates came back down, the bonds matured, and even that shocked me. I mean, what the heck, we should have free money market. But there were people that had long-term bonds dropping 20-25%. And again, because I have corporate bonds, which were 4 or 5%, but big drop, I should have put it. I wouldn't kind of love it. The thing is, 4.5%. If new bonds, just like those, come out at 5 or 6 or 7, then you try to sell it, you'll take a loss. But the good thing for you is, if rates keep falling, you'll keep those higher yields, and then somebody will want to give you a premium. And I don't know that I would want to sell it, and as you get close to maturity, that premium dries up, because, but we were in ultra short term, even in the short term, I was sweating it, we're down 3%, 4 or 5%, but remember when I said, okay, now if rates start to fall, or these come closer to maturity, they'll roll over and buy new short-term bonds, the thing's over. But we know of another person very high up that manages money, and he had put the bonds in long-term 30-year bonds, and he's freaking out because he's down 25%. Plus the stock market was down 25%. Well, we were down in the stock side, but our bonds were, 2, 3, 4, 5%, but we recovered. So, but going forward, if you think interest rates are going to stay the same or go down, longer term maturities are okay. It's just longer.
Yeah, so at that point, you're just taking gambles on what you think the interest rate's going to do.
Those skills for a longer period of time. If I run out and I buy something like a short-term bond at a much higher rate than if you had an intermediate-term bond, when it matures, it can drop. Or if I get a money market fund, it drops daily, right? So if I say, I don't like your bonds, I'm going to buy a money market fund, paying the same for, I can increase that yield overnight.
Yeah, so that's kind of like one of the reasons why whenever I'm building portfolios is like, especially when we look at the yield curve and we see the intermediates and longs are just still not even paying very much. They're still at 3%, 4%. Well, why am I going to buy this? Like even just at all, because the short-term bonds are still paying so much. And it's just like, it's hard to weigh that difference, especially when the short-term bonds keep holding it and they have way less sensitivity. So if I go buy that longer-term bond and then rates start to rise up, then it becomes worth even less. But fortunately, some of the longer-term bond funds that I've held have gone up in value because we saw that rate cut. That helped me out a little bit. Granted, I kept those holdings really small because I don't want to introduce that extra risk, but duration is basically just a way that you can look at the risk of the bond funds and how you can adjust that. Because you want to make sure that if you're creating a cash position, you're not also adding a crazy amount of duration risk, thinking that your standard deviation is going to stay nice and low, then interest rates go rising up for whatever reason, and now your bonds fall and your cash position is super small. We don't want to have that
You
happen.
want to create your own annuity with a government bond. You don't care about the price going up and down, and if you get a deal and if rates fall, if you had $1 million, I'm older and I have no other options, and I want to lock in this 4.5%. I get $45,000 a year. I don't have to worry about rates falling. Because what if they fall again? Now you're out of the short term. Now we're out of fun.
So one more thing that we'll look at, or actually there'll be, one more bond related thing that we'll look at, something else, and then we'll move to Morningstar. But here we've got basically the credit rating of a bond fund or bonds. So this is an independent assessment of a company's or government entity's creditworthiness with respect to a particular debt or financial obligation. Now we expect, or we like to say, that US government bonds are not even on this list. They are quadruple A's. They're so perfect, they will never default on any debt ever because they'll just make more of them, print more dollars to pay you back with, and everything will be fine. So the US government gets to sit way above these ratings. But for everybody else that's actually beholden to the economy, they will have different credit ratings based on how much they're able to pay back their debts, how much they've been able to pay back their debts, and how their financial circumstances are looking currently. Everything from BBB or BBB minus above is considered investment grade. That's considered good enough that you're not worried about defaults. You're not worried that it's going to be a bad investment. You know you're going to get your money back, or at least you're very confident. And everything, A's and AAA's and AA's, all good stuff. Now to consider, the further you go down, the more they have to compensate you for the risk that you're taking. It's just like in a stock. If you have higher standard deviation, you want to see a higher average return. If you see a lower credit rating and there's a higher chance that they're just never going to pay me back, period, that interest rate better be freaking sweet. Like you better be paying me 6, 7, 8, 9% versus the US Treasury's 3, 4, or 5. So the further you go down this list, the higher the yield will be because they have to compensate. It's like if you have really bad credit score and you go to get a loan, you're going to be paying 20, 25% on that loan because they don't think you're going to pay it back and they need to get compensated immediately before you default on it. Same thing with bonds like this. Maybe try not to buy a D bond because it's currently in default. That would be probably the wise choice. If you're going to buy junk bonds, buy a diversified fund, buy something that holds a lot of different things so that you're not beholden to each individual bond. If you buy one junk bond, it's kind of the same as buying an individual stock. That rate of default, that risk of default is way worse than if you hold 100 junk bonds, where maybe 30 of them will default and you keep 70 or whatever. I don't know what the actual default rates are. But basically everything underneath BBB is junk or high yield. That's the nice gentle way of putting it. And then everything above is investment grade, what you would normally see in a high grade bond fund.
What's the likelihood of a AA dropping to a junk?
It's pretty low. Like there has to be something really bad happen. Although what I will say, if you guys remember 2008 a little bit, if anybody's watched the movie The Big Short, there's a really interesting scene in there where these hedge fund managers, they get themselves over to Standard & Poor's, the Standard & Poor's ratings office, where they actually rate the bonds. And pretty much what was happening was these companies would bring their bonds in, Merrill Lynch or whoever it was, they'd bring their bonds in and they go, hey, can you give us a nice credit rating? They would wrap all these different complex investment products together, all these mortgages, and they would just kind of go, it looks good enough. Give them their AAA, give them their AA rating, and just take the fee because they knew that if they didn't do it, they'd walk on over to Moody's down the street and get the AA or AAA rating, thereby inflating the credit rating of all these companies, when really we were talking about C bonds, C mortgage bonds, and maybe even some Ds in there that nobody was talking about. But they would just package them together, make it a little more difficult to look at, and then they would go, I don't really want to do all the paperwork and sign off on it, push it away, fee for ratings type of stuff. Yep.
And unless you were on the bond, and for example, from the G, we probably would favor the rating for one of the bond. That's why we don't recommend individual bond. I think right that for really large debt funds, one small bond. And even they were disappointed that they have had people in longer than bond, they didn't move that.
Okay, last couple things before we pull up Morningstar and just have a little fun looking at some different funds with all these different metrics we've been talking about. Firstly, we've got the 12-month yield, which for some reason, now when I look at Morningstar reports, they just don't put on there anymore. It's always zeroed out. There's no data there, which is really frustrating because now I can't look at the yield of an investment for whatever reason. It will still show up when I go to search it and look at the different columns on Morningstar. But as soon as I create a report, there's no data there. I don't know why. Anyway, SEC yield is more useful anyway, and I'll replace that on here soon. But the 12-month yield is basically the sum of all the income distributions from the previous 12 months divided by the last month's ending net asset value. So we'll be looking at capital gains distributions, dividends, interest, all that kind of stuff. And then we take the last month's, the value of all the stuff in the fund, not the price of the fund, but everything inside of it. And we'll divide it by that to see how much has been paid out percentage-wise, pretty much like a dividend. So it's just like a fancy way of saying dividends for funds, and that includes everything that comes out as income. And again, income refers to interest payments on debt and dividend payments from equities. And that in some other funds, like derivative income funds, that can also be option premiums and swaps and all sorts of fancy stuff that we're not super worried about right now. And then next, we have potential capital gains exposure, which, again, really only a problem for mutual funds. ETFs can distribute capital gains, but you basically never see it. But potential capital gains exposure refers to the percent of a fund's assets that have unrealized gains. So if I'm holding 10 different funds or 10 different stocks, and I've got 2 stocks that have a bunch of gains, that's at 20% capital gains exposure. So we've got those 2 assets are exposing me to capital gains. If the mutual fund sells those to buy something else, they're going to kick out those capital gains to me. I'm going to pay the taxes, or if it's in a qualified account, I'm going to defer them. And then that's going to usually, if the instructions are set by default, they'll reinvest back into the fund at the net asset value when it was distributed out. So a negative percent indicates there's capital losses, which could be used to offset capital gains in future years. If a mutual fund has capital losses, unless it's part of their strategy to rotate out of that position and do something else, they're going to hold on to that until they have another position with capital gains, and then they'll just net them out so there's no effect to their shareholders. And again, this is only really a concern for non-qualified retirement accounts. We don't care what happens in our IRAs and 401ks because we're deferring those taxes anyway. Or better yet, Roth accounts where we're never going to pay that.
They're always qualified. That's retirement accounts.
So, non-qualified retirement account. It's there. I think this was written in a different way, but there's like. So for tax reasons, there is deferral and you can defer those things. But in terms of qualified plans, there are some things that are not considered qualified plans. And usually that refers to, what am I thinking of? Like non-protected, non-ERISA protected. So this isn't supposed to say retirement accounts. I don't know why I have it in there. We're just talking about non-qualified investment accounts in terms of the tax purposes. Yeah, pretty much. Yeah, individual and joint, community property and trust accounts, all that sort of stuff.
But
yeah,
this
taxable.
account qualifies for a tax deduction, qualified account, retirement. And this one doesn't qualify for a tax deduction. I just made it up.
Yeah, and then when we're talking about qualified plans, usually that's talking about whether they qualify for creditor protection versus whether they don't. So it's it can be a little bit different. But let me get Morningstar up on here.
Yep, and usually Nash will say, only your high dividends and bonds, but if they income retirement, don't get down. If you're gonna hold it, part of that, better create fund for tax efficient.
Okay. If at any point anybody has a fund they want to look at, please throw it out there and we'll take a look. But I'll just start with some of the things that I have in my portfolio here.
Either they can go or something else, so we don't have to go. I think bring up the symbol and look at it and like here. And again, you might have a really profitable fund that no longer looking, so that now you got to fund that difference in a not qualified account. It's in a qualified account, so it's not.
Let's see if I can. Oops, that's not what I meant to open. Okay, so if we look at this here, we can see that there's one of the funds that we used in our sample portfolio before, the Invesco S&P Small Cap Momentum. And you can see that we've got, up here is what I was talking about, we've got our two different indices. We've got the standard index, which is the S&P 500. So that'll be one of the ones we're comparing to. And then you have the category index, which is basically when it says the category average versus the standard index. You've got the standard index as the S&P and the category index as the Russell 2000. So here you can see on this graph, you've got three different lines, one of them being our investment, one of them being the category average, which would be that Russell 2000 growth, and the standard index, which would be the S&P 500. So we can kind of see the difference in the returns, where the standard index is actually sitting up here above for a little bit, and it does better at times. And if we drop down, we can see some of our different measurements over here. So we've got our standard deviation over on the left here for different time periods. Like I mentioned, there's the 3 years, the 5 years, and the 10 years. So you've got your standard deviation, you've got your mean returns, and your Sharpe ratio. So the Sharpe ratio is one of the things we can look at again to see if the risk-adjusted return for this portfolio has been worthwhile and has been actually positive. And we can see that for the level of risk that we're taking on in terms of standard deviation, we are actually eking out a little bit of extra return. Yes, but that's fine. Yes, the portfolio of the fund is what I mean.
Oh,
And you can see that the beta is a little higher, and you can see that we're comparing towards, we have the MPT statistics for the standard index and for the best fit index, which is the Russell 2000. And you can see that the beta is a little bit different for each one. For the S&P, it's not quite as correlated, but for the Russell 2000, it's more correlated. And that's because of, in the S&P, those small cap holdings are much smaller, so they're contributing a lot less to the returns of the S&P 500 fund, which is why the R squared will be lower when we compare to that. Versus when we compare to the Russell 2000, we see it gets up to 90, 91.42, and that becomes a much better comparison of beta. We could see the 12-month yield, which actually does show on here as 0.51%. Not going to be using this as a dividend fund, that's for sure. Yeah, and now let's look at another one. We can look at possibly this one here. Yes, in fact, all the time. That's usually what I start with, is if I know exactly what I'm looking for, if I know I'm looking for a small cap, or if I'm looking for a short-term government, I'm looking for any of these things that I already know what kind of fund I want to put in there specifically, I'll use Sharpe on a 10-year basis, no shorter, and I'll start there. And I'll look at the first few funds that show up and look at, okay, what of these have performed best for its volatility over the long period? In fact, why don't I just kind of show you what I do. So
for the non-index, because an index fund is the same.
yes,
Non-index funds like factor these, food space or anything, different types of funds, passively managed, that's all that. You want to see if it's that working.
yeah.
This is how much better they've done. This, the last one they compared to its own index, it's 6.5 better.
Yeah. So, okay. Give me a category of fund, just any sort of sector or whatever. Growth and income. Okay, great. So,
That would indicate that the manager actually take some of the best growth. Some of this is growth. Index is bringing to the shopping list of one of everything. But if you want it to be a little bit different or more or less than, then you have to go to the.
We'll just do dividends.
Exchange traded fund. It's like an index, but if they might rebalance it one time a year, or they, let's say, S&P, dividend stocks and not growth stocks. So beyond the actual index, now you're asking for custom basket. And so he's looking at dividend basket or out and or management.
Yeah. So if you look here at these first couple things, what I did was I sorted for a monthly data 10-year Sharpe ratio. So over the last 10 years, how much extra return have we generated in comparison to the standard deviation of these holdings? And you'll see that the very first one for dividend stocks is Wisdom Tree's US Quality Dividend Growth ETF. You'll notice that it has a little bit higher expense ratio. But we've also got Vanguard's Dividend Appreciation ETF, which only charges 6 basis points and gives us just about almost the same Sharpe ratio. So that kind of shows that you see there are these super low cost funds up here. Yet another one is iShares at 0.08. And we, yes, have 2 of these more expensive ones, but you don't see 1.5%, 2.5%. You don't see those crazy high expense ratio funds up here. You'll see 2 very inexpensive, probably index funds. So these index funds will actually give you a little bit of Sharpe because, again, it's not comparative to anything. We're just looking at it in isolation, how it's doing on its own.
My Sharpe ratio of 1.
Yeah, I believe so. I believe it's 1. Yeah, I don't know if. Yeah, I think it's anything over 0. I don't know if I've seen anything over 1 before, or I guess it depends. I'm not sure. Maybe if we look at growth, let's see. Let's see what happens if we go to growth, because that'll probably tell us. Highest one here is 0.93, which is interesting. But yeah, again, you can see these are not your most expensive funds. In fact, these are probably index funds, again, that are giving us like this extra return on top of the standard deviation. If we were to do comparative, if we used alpha, we might have different funds show up. In fact, let's see what happens if instead we take a 10-year monthly alpha, put that right here, update, let's sort by this. And you'll see it's pretty much exactly the same. It's the same stuff. Because again, these are going to be the similar sorts of things. These might be very close to, but not quite an index fund. But you'll get a little bit of alpha on top of that. In fact, you can see just about 3% of extra return on a 10-year basis. So remember, that's an annual amount of alpha. So that's actually going to compound to a really decent number. So this is
Slightly different than whatever index you're comparing yourself.
yes, or to have positioned yourself in a tactical way based on market timing.
Either market timing, management, or your.
Exactly.
And that's the whole way to find the fund that regardless of good or bad, if it's got a better Sharpe ratio, the less risk, more return.
Exactly. Exactly. And that's again why I want to look at 10-year numbers, because I don't want to see how they've done over the last year, over the last 3 years, because that could have been a lucky streak, like ARK did with Tesla. If I looked at that period and I looked at their alpha or their Sharpe, it would look amazing. The Sharpe for the 1 year that Tesla went flying sky high would look incredible. But if you look over the long period, it's probably not going to be great. In fact, let's see what it is. Oh, it doesn't even show up here. Great. Never mind. Yeah. Oh, it's because I have this selected here. That's why. There we go. Yeah, they don't even have a 10-year, so maybe we can get let's just get all of these. Let's see. 3-year and 5-year. Yeah, so if you look, look at the alpha of the ARK fund over 10-year or over 3-year basis and a 5-year basis, it's really bad. Buy the S&P; it'll work out for you. So
For a while there, she could do no harm. She could do no wrong. Everything she touched might be gold. And she's doing better now, but that's because she stood up there saying, I'm gonna risk your money and go into the storm. And if you're right, she gets all the credit, and if she's wrong, then we just find somebody else. That's why we'd rather have you decide, create a portfolio with less variations and less managers that are heroes one day.
Yeah.
Nobody-
So that's a couple ways that we can use to evaluate individual securities and be able to put them together and get an idea of how our portfolio is going to do over time and how we can pick the best funds. Hopefully that gives you a decent idea of if you want to go to a Morningstar, if you want to start looking through your fund provider's options, how you might pick something and how you can judge whether it's actually done well over time. And there was also this little handout that we gave out because the third week in October is National Estate Planning Awareness Week. So it's just another one of those reminders to really just look at your stuff, make sure that you have things moving in the right direction, make sure you've done your estate plan and that anybody around you has done their estate plan. You don't want to forget. You don't want to end up putting somebody in a situation where they have to clean up your mess for you, and you don't especially want to stop them from having the time to grieve a loss. That's one thing that really hurts, is when you have somebody, if you lose a family member, but you're not able to process that because you immediately have to go into the mode of dealing with the assets, making sure they get to the right place, fighting the creditors, fighting the banks for the information because you didn't process anything, or you have somebody else who didn't set the right things up for all these things to pass forward in the right way. It's really painful to not be able to grieve a loss because you have to clean up the situation first and compartmentalize. And a lot of times people will make poor decisions if they have to grieve and process your finances at the same time. So it's really important to get your estate planning together, even the simple things, just adding beneficiaries to accounts, making sure you have transfer on death on individuals and individual brokerage accounts and homes and all sorts of things, making sure you have a proper will to collect any other assets that aren't included in those, and using a trust when you need to. So just give a read to this, see if there's anything here that speaks to you or anybody you might know, and just let them